Thank you, everybody. Welcome to the University of Essex University Enterprise Zone, part of our Space to Grow and Angels at Essex programs of investment readiness, providing business support to those entrepreneurs who wish to delve into the world of equity, and to those investors who are more interested in the details of investing into equity-ready firms. My name is John Stenhouse. I'm the Business Support Manager, and I'm ably supported here today by Josh Clark, who is managing the IT side and keeping me in order, and also to Peter Harrup from BDO, who is our guest presenter today and our tax specialist. So Peter works for BDO, a leading accounting firm which covers our area, but is an international accounting firm. Please be assured that the fact that when you're talking to BDO, you can access accountants from all around the world. Peter is our tax specialist. And when I say our tax specialist, I mean that is a specialist area, believe me. And tax can be very boring, but not when Peter's presenting. So I will welcome Peter on board now. And would you like to entertain our guests, please? Thank you.
So, SEIS and EIS tax reliefs. I'm going to cover these and go into detail about what the reliefs are, how they affect investors, and what impact it has on the company as well going forward. So, Enterprise Investment Scheme was first introduced in 1994. It's been part of the UK landscape for over 25 years. 28,000 companies have raised over £18 billion in equity finance in that time, so significant sums. Also in 2012, a seed EIS was introduced, which is available to smaller companies in startup, and what I'll do is I'll cover that in more detail as we go through. This is also part of a package including venture capital trusts, and whilst these give sort of similar reliefs, and I'll make some reference to it, the main emphasis of the presentation is around EIS and SEIS. So I'll go on to a bit more detail as we go through. The idea is that investors will look to get tax reliefs on equity finance. So this isn't around loans. This is about acquiring shares in a company. And also the reliefs not only provide upside, they also provide downside. Unfortunately, a lot of startup businesses unfortunately won't be successful a lot of the time through no fault of their own. But by allowing tax reliefs, it means that the pain for the investor isn't quite as large as it would otherwise be if you lost pound for pound in the event of the business being unsuccessful. Acts for a benefit for unquoted companies. In practice, FTSE companies wouldn't be looking to sort of tap into this kind of relief anyway. But so I'm sure that all the people that are on the call today would have unquoted companies. So just your typical limited company rather than a PLC. So this screen here just gives a summary of some of the things that I'm going to talk about in more detail as we go through. So if you see across the top, we've got SEIS, EIS and VCTs. First of all, the income tax relief. So an individual could get 50% income tax relief for SEIS. If they invested the maximum amount of 100,000, they could potentially get 50,000 income tax relief. Figures are slightly less for EIS, 30% income tax relief. So if you're able to put in the whole of the £1 million, you could get in theory up to £300,000 of income tax relief in any year. One of the main attractions for obtaining SEIS and EIS is there's a tax-free exit. Certain conditions need to be met, but ultimately if you sell these shares, there's a chance of paying no capital gains tax at all. I'll just put up their dividends. Any dividends paid on the shares would be taxable in the usual way. So if you're a higher rate taxpayer, it may be 32.5% or 38%. Just compare it to the VCT, where you'll see that there are tax-free dividends in those circumstances. But as I said earlier, I'm not planning to cover them in any further detail. Also, if you've made some capital gains, so for instance, you've sold some residential property, perhaps you've got out of your buy to let and made a gain on it. There's a possibility of deferring some of that gain so that the capital gain gets pushed into a later year when you'll pay tax then. SEIS has the advantage that also 50% of that gain falls away. So if you were in a position to invest 100,000, it's possible that 50,000 of gain could fall away and only be taxed on half of that at a later date. In order to qualify and continue to qualify for these various reliefs, the companies need to continue to qualify during a qualifying period. In the case of SEIS and EIS, it's a 3-year period, and I'll touch on that further later on. And also, this has advantages for inheritance tax. If you had an investment of 100,000 in a limited company, then often that might attract inheritance tax of 40%. But on the basis that the rules for inheritance tax and for SEIS and EIS are very similar, you'd expect to be able to get 100% relief and have no inheritance tax in the event of dying with these shares in your portfolio. So there's some really good reliefs there. Obviously, what you need to do now is put a little bit more meat on the bones. So one of the things that I often get asked is, what about the shareholding? What's the largest shareholding you can have? And the largest shareholding you can have is 30%. Now, one of the first questions I get asked by a lot of clients is, if it's 30%, can I give 30% to my wife, 30% to my children? And the short answer is no. When you're looking at what shareholding you actually hold, not only do you look at your own shareholding, you look at the both your grandparents or parents, and also going down to your children as well as spouses. So all of that is effectively lumped in together. And if your overall shareholding is greater than 30%, you're not going to qualify for EIS or SEIS. So the client that comes to me currently owning 100% of the shares wants to give away 30% to his wife or to his children, they aren't going to qualify for this. Interestingly, you could give 30% of the shares to your brother or sister and they could qualify. But in my experience, that hasn't happened to date. People don't seem quite so keen to give the money away to their siblings, particularly when they're going to get a tax-free gain. But there's always a possibility that it's out there. And that I'm sure I'll come across one of those one of these days. There's other anti-avoidance provisions. So you can't have an arrangement where you say, if I acquire 30% in your company and you acquire 30% in mine, we can get EIS. They're related, and there's provisions in there that stop that happening. You can't have it linked to loans. You can't have tax avoidance as a main driver. We rarely come across that in practice. There's some issues about what monies you can actually get out of the company going forward. And also another big one here is that if you're an EIS investor, you can't hold other shares other than those that also qualify for relief. The final one is that in order to get a tax-free disposal, you must have claimed income tax relief, even if that's £1. And again, I'll touch on that later on as we go through. So we talk about the income tax relief, 30% on the first £1 million. It's very rare that we see £1 million going in any one year. It tends to be a lot smaller sums, but nonetheless, 30% is very attractive. The amount of income tax relief isn't restricted to the amount of income tax that you actually pay in the year. So for example, if you'd pay 20,000 of income tax and invested 100,000, you couldn't get all 30,000 back. You could only get the 20,000 because effectively that's the income tax that you've paid. So often there's some planning for investors where you make sure that you maximize your relief, and that possibility to do that in the current year or carry it back to the previous year. Normally that's not an issue. The amounts that you can invest are doubled for knowledge intensive companies. I will come on to knowledge intensive companies later on in the presentation. So if you think that you've got a knowledge intensive company, we'll talk about some of the rules there and indeed ask you whether you think you do qualify. But as I said earlier, the tax relief is limited to the tax liability in the year. And sometimes what you find is you haven't actually got an income tax liability, but you've got some income covered by your personal allowance. It's perfectly acceptable to not claim your personal allowance create a tax charge, and then effectively set off your EIS against it to make sure you get the capital gains tax rates at a later date. So one of the other main attractions is to get tax-free capital gains at a later date. So if you were to sell shares and other reliefs didn't apply, at the present time you'd pay 20% tax. So if you made £100,000 of capital gain, you'd pay £20,000 of tax. But if you've qualified for EIS, you wouldn't have any tax to pay on that £100,000 gain at all. So you can see the attraction. You need to have claimed the income tax relief, as we said before, and you need to hold the shares until the termination date. So this is holding them for the 3 years and beyond. If you were to sell them within that period, then the release would fall away. And as I said earlier on, one of the key things to do, particularly when you're an investor, is to make sure that you get the maximum relief for income tax purposes. And that may mean having a look at what your income tax liability was for the last year as well as the current year, and plan your investments accordingly. There's other reliefs insofar as you can defer some capital gains. So the example I used earlier on, you might sell some residential property, have a capital gain on it and not want to pay the tax now. If you're able to reinvest it into a company that qualifies, then you will not pay tax until that gets crystallized at a later date. You need to have made that gain in the 3 years before your current investment or 1 year afterwards. And also in this particular case, there's no 30% restriction. So one example we've had recently is one of our clients has sold up their business. They wanted to start up another trading business. They've invested the money into the trading business, in that particular case had 100% of the shares, and they were able to defer the capital gains. So in that particular case, 20% tax will be deferred until a later date. The gains will come back in if you were to sell those shares. So if you made a deferred £100,000 of capital gain, it would come in at a later date if you sold those shares. And the thing to just be aware of is it will come in at the capital gains tax rate at that time. Now, many of you may be aware that there was talk of increasing the capital gains tax from the current 28% or 20% to possibly income tax rates, which could be as high as 45%. So in that example, if you deferred this year and it came back in a later date when it was 45%, you might not be too happy to do that. So it does need to go, you do need to go with your eyes open. One area where that doesn't apply is where you've qualified for what's now called business asset disposal relief, formerly entrepreneurs relief. This is where you sell shares in a trading company. At the present time, you can qualify for £1 million that's taxable at 10%. That will come back at a later date at 10%, but even there are some rules that may mean that if the rules were to change between now and when you crystallise it, that you might not get the full relief that you're expecting. So if anybody's deferring the gains, they just need to go in with their eyes open, but it has a lot of advantages, particularly if you're able to defer it into some shares that perhaps you would hold at the date of death. But I'm not going to go much more detail than that at this stage. We talked about the advantage of EIS relief in the event of the company not being successful. In the event of you putting £100,000 into the company, you'd expect to get 30% income tax relief. So your net outlay at that point is £70,000. If the company was to go bust and you weren't to get anything back, you can then claim that £70,000 as a loss against your other income. In the example that I've got on the screen, I've suggested the 70,000 is allowable against income that would otherwise be taxable at 45%. So overall, the net loss is £38,500. So for the initial outlay of what could have been a loss of 100,000, in this particular case, the shareholder has only lost 38,500. So a significant saving on what could have been the position. So you can see the loss relief works in their favour, and clearly, you know, that whilst you wouldn't want to lose the 38,500, the attraction is the upside in the event of hopefully that 100,000 turns into say 500,000 or £1 million, and there'd be no capital gains tax to pay. So this manages both the upside and the downside. And we've also got the inheritance tax. In order to qualify for business property relief, you need to have held the shares for 2 years, but otherwise the companies that qualify for EIS should also qualify for 100% business property relief. So it can be advantageous to have EIS shares in your estate at the date of death. Obviously, it's not advantageous to die. I do understand that. I don't recommend it from a tax planning perspective, but nonetheless, the relief is there. So we talked earlier about the fact that in 2012, a further relief was introduced called Seed Enterprise Investment Scheme. And the reason that we're asking about how old the company is, because this applies to companies that are less than 2 years old. And in this particular case, the reliefs are far more favourable. So, for example, you can get 50% income tax relief compared to 30%. But also the amounts that you can invest are lower. So any individual can invest 100,000 per year. And you can find that on that basis, you might find that you invest 100,000 this year and also have had 100,000 for the previous year with a 1-year carryback. Also, you've got the capital gains tax exemption on sale. So again, once the shares have been held for 3 years. Another advantage with SEIS is the fact that you can defer capital gains. So if you've sold a property and want to defer your gains, you could defer up to £100,000 on my example, and 50% of those gains would fall away and you wouldn't pay tax on them at a later date. So you can see it's very attractive relief. Otherwise, pretty much works the same as EIS relief. Now, one of the big attractions for EIS relief is also to try and attract investors that will bring something to the party. Somebody that could act as a company director, not untypically somebody that has built up a business in the past and perhaps sold up and wants to give something back, but has also got some capital that they're prepared to put in as risk capital to smaller businesses in startup. Now, certainly I've found with some of my clients that what they do is they might invest in 5 or 6 businesses. They know that all 5 and 6 won't be successful, but what they hope is that 1 or 2 of them will be, and overall they'll make significant gains, and particularly if the gains are free of capital gains tax. So one of the key conditions is that either you need to be unpaid or have effectively not been a director before. So just using those 2 examples, in the case of an unpaid director, this is somebody that wouldn't get any salary at all from the company, either in the past or in the future. They could get paid for necessary expenses. So if there's travel or entertaining or anything of that nature, they can be reimbursed for those costs, but wouldn't be paid a salary. They can also receive payments up to the market rate for interest on any loans they've made, rent if they've owned the property, and payments of goods. So as long as it's at arm's length and no more than that, then that's fine. Do need to be a little bit careful with these if you've got connected persons, and I will come on to an example about that later on. But this is the case where you've got a director, they make their EIS investment, they are reimbursed for any expenses they have, but otherwise don't have a salary. Obviously, they bring their expertise and you hope that it takes off at a later date. And obviously, they're prepared to do it because they hope that there's a big gain at a later date. The other one sometimes we come across is paid directors. In this case, you can't be paid before any investment in the EIS. You can be paid afterwards, but it does restrict your ability to put further monies into the company in the form of share capital that would qualify for EIS. Basically, you've got a 3-year period to reinvest. Now, you might say that that probably doesn't matter, but often what you find is if you go for a first round of EIS, you often go for a second or third round of equity. And in this particular case, if we said that the director put in the monies on the 1st of April 2020, and the next round was the 31st of March 2024, then that would be outside this 3-year period that they could invest. So that director wouldn't be able to take advantage of the EIS relief and invest in the company at that time. So it's just something to be aware of. I say we do see lots of business angels. It's not untypical not to receive any salary, but equally I've seen the other as well. Clearly, it's a very attractive relief to get with the upside on the capital gains, the income tax relief. So I'm sure it will come as no surprise that there's various conditions that need to be met. So one is that you can't hold other shares in the company other than these EIS relief shares. Also, you need to be paying for new shares in the company. So you're subscribing for shares, and the reason for that is the idea is that you're raising cash for the trade going forward. And in particular, you can't get EIS relief if you were to acquire shares from another investor. And in fact, you might cause problems for your own investment as well. So not untypically, sometimes you find that some of the directors who started up the business want to sell some of their shares to effectively de-risk, get some cash in the bank account. But if you're an EIS investor, you wouldn't want to be acquiring those shares from them because you wouldn't get EIS relief, and also you might foul up your current investments. Also, you need to be aware that associates, as we talked about before, family members in particular, are included not only for your shareholding, but with the purpose of deciding whether somebody has been paid. So, and you can't be an employee or a paid director. And this particular example was a case where a shareholder put in £100,000. They were a chairman, weren't taking out salary out of the company, but had a grandson that wanted to go into the business, and they wanted to give him a holiday job just to tide him over. Unfortunately, because he is an associate of the chairman, it fouled up his income tax relief and EIS relief, because he effectively stood in the shoes of the grandfather, who effectively was deemed to receive salary when he was being an employee at the same time. So a few nasties in there. In practice, we rarely come across this, but it's just to be aware that if you do have investors, just think about if there's any family members within the company. And a few further details. There are detailed rules on this, so certainly we would suggest that you take advice. We've talked about the associates being no more than 30% with yourself, can't be employees. Use of funds, the monies must be used for the benefit of the trade. So that might be for the plant, it might be for marketing, it might be for software, it might be for a whole host of other things, but the money must be used for those purposes. Sometimes we have seen clients get into trouble where we've taken them on perhaps from other advisors, where the money has been injected into the bank account, but the shares haven't been issued. So in those circumstances, what happens is sometimes the revenue would say, what you've effectively done is put a loan in, and that loan has been converted to shares. In those circumstances, you wouldn't qualify. So it's key that you get all your ducks in a row, make sure the money goes in and the shares are issued simultaneously, or as near as simultaneously as you can get it, so that it's clear that the monies have gone in for the share capital and haven't been loans. There's a few issues if you want to look at restructuring that won't go into here, because I'd imagine the majority of people on the call would have probably a standalone company where the shares will be issued from that company. And you might just need to think about what the interaction is with other share schemes. In particular, the EIS must have no better rights than any other shares. So sometimes people have got caught out where they've introduced share schemes where the EIS shares have slightly better terms than other shares that have been issued, and again that causes problem for the EIS shareholders. So again, I would say this, but I'd encourage you to take advice from an advisor who's experienced in doing this to make sure all the reliefs are first of all obtained and kept so that your investors get the most out of it. Now, because it's very good relief, there are restrictions on the companies that you can invest in. They must be unquoted companies, which doesn't tend to cause a problem. They must be trading companies, not investment businesses. So investment businesses, very simply, might be where you've got property that you're renting out and receiving rental income. There'll be other examples of investment businesses. Trading companies in the main are where you're selling something on a regular basis. I'd like to think that in the main, a trading company is pretty obvious, subject to a few exclusions that I'll come on later on. The age of the company is important. We've talked about whether it's 2 years for SEIS, for example. You look at the gross assets, and I'll touch on that shortly. It must be an independent or have qualifying subsidiaries. So what I mean by that is if it's a standalone company, that's fine. If you happen to have a holding company with some subsidiaries, you need to be investing in the top company. And it's aimed at looking at smaller businesses to grow. So there are restrictions on the number of employees and the business that you can invest in. And I'm going to expand on some of those a little bit further, so you've got a bit more meat on the bones. So this is sort of a nice summary. The age of the business that you can invest in is 2 years for SEIS, 7 years for EIS. Gross assets, 200,000, so relatively small business. And the gross assets is looking at fixed assets, debtors, cash on the balance sheet. And for EIS, it's a larger company, £15 million pre-investment and 16 afterwards. So if you were at 15, you could effectively raise £1 million in that year and still be able to qualify. Number of employees for SEIS, less than 25, for EIS, less than 250. And the maximum investment for the company is £150,000 for SEIS, 12 million for EIS. And of that, the maximum investment for an individual is 100,000. So in the SIS, you could have one investor for 100,000 and perhaps two others making up the balance of the 50,000, and they should all qualify. So we've talked about the 2 years. So with an SEIS company, that broadly starts from when you're open for business. We would say, as a rule of thumb, look at when the company was incorporated. And if you're looking to issue the shares within 2 years after that, you should be safe. If you're looking at anything after that, you just need to have a closer look and make sure that you are still within that 2 year period. Otherwise, you may have to look at EIS relief rather than SEIS. For EIS, it's a little bit more lenient. You've got 7 years, and that's from the date of the first commercial sale. And for the knowledge intensive companies, you've got 10 years. And in that particular case, either the first commercial sale or in the counting period where the turnover is over 200,000. So normally with the knowledge intensive companies, there would be plenty of time. And I'd like to think you wouldn't come up against the 10-year period with it causing a problem for any of your investors. We talked about the gross assets, talked about in general that they are just looking at the assets on the balance sheet. It's not taking off any liabilities. So if you had 300,000 of assets and 300,000 of liability, you would still not be able to qualify because your gross assets would be above the 200,000. Same goes for EIS. In that particular case, it's £15 million. There are some issues if you're in a group that effectively, because sometimes you have intercompany debts, they get ignored for these purposes. And also sometimes you would have goodwill on the balance sheet. So this is where on a consolidation, you might say that the value of the assets is, for argument's sake, worth £2 million. But with what the company is actually worth is 3 million, in which case the excess is referred to as goodwill and is £1 million. The goodwill is ignored for these purposes, so that doesn't have to come into it. So on a consolidated, you remove the goodwill as well. But I say the majority of smaller businesses, that doesn't come into play. Talked about excluded activities. The idea is that it's aimed at trading companies that have got risk. Basically, they're not allowing you to invest in companies that are typically property backed. So anything dealing in land or property development or hotels and nursing homes, they're saying that because a lot of the growth is in bricks and mortar, they're not going to allow that. And sometimes you have leasing or receiving royalties that can get treated as excluded. I'll come on to the exceptions of that shortly. You'll see that legal and accountancy services, which obviously affects myself, but there's no problems with that. Farming and market garden is another one that comes into it as well. So there's a few excluded. The majority of businesses that we come across are truly trading and don't fall within these. There are even a few exceptions if you just look at these in isolation, and you can find that sometimes you still qualify. So it's worth looking into in a bit more detail. If you are looking to develop some software, or you're looking to develop something else that will effectively give you some intellectual property, and there may be royalties or license fees at a later date, that company can still qualify on the basis that the greater part of the value is from intellectual property that you've created yourself. So it doesn't immediately rule it out. So again, that's something to be looked at. And the company could still qualify for your EIS relief and all the reliefs that go with it. Fortunately, if you have an element of these excluded trades within your business, then there is a 20% tolerance, and the revenue will look at various measures: turnover, profit, assets employed, etc. And if the numbers are below 20%, then that wouldn't affect either your claim at day one or affect the ability of the company to carry on qualifying for the 3-year period. But you don't want to breach any of those on the 20%, otherwise potentially you could lose the lot. So certainly with those companies where we have got an element of that, we very much encourage them to monitor that very closely on a monthly basis. Talked about the fact that you need to have a 3-year qualifying period, and the company must continue to meet the trading qualifications through that 3-year period. Must continue to be independent, so either you'll carry on to be the holding company or the only company in there. When it comes to the rules on employees and gross assets, I describe that as being a photograph. So what you're looking at there, the numbers, the 25 or the 250, and the gross assets of 200,000, you only need to look at the date of that you actually subscribe for the shares. It could grow significantly in the following 3 years, and that wouldn't fall foul. I described the first bit, I would say a video, it's probably a little bit old now, but if we say a film, and the second part as a photograph, and then you find that certainly there's sometimes some discussion where companies are close to the numbers, but if you're below the numbers at the date of investment, then certainly employee numbers or gross assets wouldn't lose you the EIS at a later date. I just mentioned that you can't be in partnership, but I'm not going to go into that in any detail, so I'll flick through that. And also point out that there must be risk capital. Clearly, where you've got monies going into a startup company that is going to sort of try and start trade and is relatively in embryonic stage, is clearly going to be at risk. This was really brought in for a number of more sophisticated schemes where there was a minimal risk to the capital that was injected, and more it was about getting your 30% income tax relief and getting your capital back at a later date. But nonetheless, it is there. Right, so as we said earlier on, knowledge intensive companies have better relief so far as you can raise more capital. Knowledge intensive company is one that has 15% of its costs in one of the last 3 years that have been spent on R&D, or 10% of the costs in each of the last 3 years, and is engaged in creating intellectual property. So that might be software or something similar. Also needs to be reasonable to assume that within the next 10 years, most of the company's activity will consist of the exploitation of that IP, or at least 20% of the workforce are skilled employees and have what we say there is have master's degree or higher and are directly involved in the R&D. There are special rules for less than 3 years, but there is the basic conditions for knowledge intensive company. So hopefully that sort of gives you an indication whether you think you do qualify or not. So having decided that you want to proceed with raising finance through equity, and you're hoping that your shareholders are going to get EIS relief or SEIS relief, what is the normal process? Well, often what we would do with clients is talk about getting advanced assurance. It's not compulsory, but by going for an advanced assurance with the revenue, you get confirmation that the company should qualify for EIS or SEIS, and the investments should as well. And if you're an investor, they'll often insist that you get advanced assurance to confirm that there's pretty good chance that they will get the reliefs that they're expecting. It's a case of providing various information to the revenue, and it's also a case that you need to show that you've met various qualifying conditions. One of the other advantages is if for any reason the revenue decided that you did fall foul of any particular point that could be changed. Obviously, you can change it at that stage before you get your investment rather than afterwards when it might be too late. I think it's best advised to get advance assurance. It gives sort of comfort both to the directors who are raising funds for the company and also the investors as well. So if you're going for advance assurance, what sort of information is required? They're looking for a business plan, financial forecasts. They want to find out how the money's going to be spent. So it's not uncommon to effectively have a grid showing that it's going to be spent on plant and machinery, marketing. Perhaps you're going to take on some more employees. Perhaps there's some kit that you need to invest in. It also needs to provide, in this particular case, company articles and any shareholders agreements. And the one that's sometimes problematic is a list of investors. Now, if you didn't have any investors, the revenue wouldn't accept the application. But if you've got at least one, ideally several of them, but you've got perhaps one or two that you're still waiting to hear from, you haven't got names, then we would expect to get advance assurances on that basis. But they don't really want just sort of fishing expeditions by yourself, just sort of say, make an application just to see if you could qualify. They want it to be reasonably serious, that there is an application that is going to be made at a later date. Like I say, this helps on both sides, so you know that you should get the qualification. And it also helps when you actually issue the shares. I mean, the process then is that the shares get issued, and at that point, the company will complete a form, depending on which relief you go for, either an SEIS 1 or an EIS 1, and it's a compliance statement. That will go in. If that's on the back of an advance assurance, it's not complicated because you've already got your advance assurance. It's probably just updating some of the numbers, and it may say that you've decided to invest. You might have said you're going to invest 100,000 in marketing, but it's now 200,000, for example. If you haven't gone for the advance assurance, then basically all the work that we talked about before will need to go in with that application. Like I said, you then hope that it doesn't get thrown out for obvious reasons. So you'd like to think it wouldn't at that stage, but it's always a possibility. And again, we would encourage you to use professionals to do it. Obviously, I'm promoting BDO for obvious reasons, but yeah, I very much encourage you to get professionals involved to help you with that process.
So in terms of, we've got a question here on, in terms of the max investment for SEIS and EIS. So with the max values, is it per investor or in total for a business who is raising?
So there are two. So one is for the investor themselves in any particular year, and the other one is a total that can be raised by the company. So the numbers earlier on, so for example, with SEIS, you can raise £150,000 in the year, of which a maximum would be 100,000 for any one investor.
So with the limit for SEIS being 100,000, if you wanted to raise more than that, can you get investment through both SEIS and EIS?
Yeah, so a lot of clients would start off with SEIS and then go on to EIS afterwards.
Would that have to be done staggered, or could you do it at the same time?
What you would normally do is probably staggered. Normally what would happen is you go for a first raise and then you'd go for the second raise. Is what we've certainly seen with clients, where you go for, I say initially you perhaps go for the 150 for the first raise with the SEIS, and then go with the second raise with whatever other monies you want to raise at that point.
Does EIS only work for the top company in a group structure?
So you couldn't get EIS if you invested in a subsidiary. EIS only works where you acquire shares in the holding company. Mm-hmm. And the reason for that is that the company must be independent, and it wouldn't be independent if you were investing in a subsidiary.
That's a reasonable comment, because we do get people coming to us wanting to set up an investment into a project, but they want to isolate that project into a separate subsidiary company for obvious reasons, often advised by their accountants. But of course, investors really want to invest in the holding company. They want to invest into the whole project and all the other aspects that are going on. So it is rare to see a subsidiary actually even applying for equity, let alone getting any form of tax relief. Another question which we're asked frequently, because being a public body, when we invest in convertible loan notes. And the Future Fund has been very good at matching convertible loan notes with their own convertible loan notes and continuing to do so at the moment. How does that affect EIS, SEIS relief? Do you know?
So the convertible loan notes, effectively you converted to shares at a later date. And that in itself won't cause problem for the EIS that you've already got, but it would prevent you from making a further investment for EIS.
When you say making a further investment for EIS, would that be as the investor or as the company?
As the investor.
So effectively, it doesn't really affect the company at all. It's the investor's status. And I think that's something to make clear as well, that whilst it's the company that goes and gets EIS, SEIS, etc., it's actually the investor that benefits from all the tax relief and all the perks that go along with it. It's just a means of the company helping encourage investment. But of course, I would argue that should the investor really be worried about the tax relief? Should they be more interested in getting a good return on their investment in the first place and investing wisely in that respect?
Because I'd say get both.
And I think that's the correct answer if it was in a poll. So
you are right though, isn't it?
Yeah. I think it's a case of investing wisely, and it's probably fair to say that having a mix of those with tax relief, which are perhaps less sure of a return, possibly. I'm not generalizing too much here, but and actually risking your capital in other areas as well. Of course, all capital is at risk. Peter, thank you very much indeed for the presentation today. Slick as usual.